A five reverse mortgage presentation on housing loan packages. What do they mean? The most popular forms of housing loan packages are fixed rate and floating rate, which are pegged to the SIBOR and the SOR. Before we move on to the actual packages, let us first examine how the lock-in periods would affect you. Housing loan packages come with various lock-in periods, ranging from no lock-in to a 1 year, 2 year, or 3 year lock-in. The lock-in period means the amount of time that you are committed to keep your loan with that bank. So what happens when you decide to sell or refinance your housing loan while you are still within the lock-in period? Well, the bank will charge you a lock-in penalty. This lock-in penalty is typically in the region of 1.5% of your outstanding loan amount. We will now move on to the various forms of housing loan packages. The fixed rate packages are exactly what they mean, fixed for a predefined number of years. A typical fixed rate package would look like this: fixed for a certain number of years before it switches on to a floating rate package. Here are more examples of fixed rate packages. The advantage of a fixed rate package is that it allows you to determine your cash flow during the tenor for which it is fixed. One of the most commonly used floating rate package is the SIBOR package. SIBOR is an abbreviation for the Singapore Interbank Offer Rate. What this means to the layman is that the rate at which banks in Singapore lend each other money. The SIBOR is a transparent rate that is determined by market forces and fixed by the Association of Banks in Singapore. You can find the daily SIBOR rate in the Business Times. This is what a typical SIBOR package would look like. It would have the lock-in period as well as the premium that is being charged above the SIBOR rate. Let's take a look at the following example. Where the current 3-month SIBOR rate is 0.48%, the interest rate that you will be charged would be this 0.48% plus the premium of 0.75%, thus making it a total of 1.23%. As the rate that has been used is a 3-month SIBOR rate, this interest rate would change every 3 months. Another commonly used floating rate is the SOR rate. SOR or SOR is an abbreviation for swap offer rate. The swap offer rate is a forex forward implied rate calculated from Singapore dollar and US dollar forwards. It is fixed by the Association of Banks in Singapore. Just like the SIBOR, the SOR is also a transparent rate. It can be found in the Daily Business Times. This is what a typical SOR package would look like. It would have the lock-in period as well as a premium that is being charged above the SOR rate. Let's take a look at the following example. Where the current 3-month SOR rate is 0.21%, the interest rate that you would be charged would be this 0.21% plus the premium of 0.55%, thus making it a total of 0.76%. As the rate that has been used again is a 3-month SOR rate, this interest rate would change every 3 months.